Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Welcome, Scott.
Jeff, how you doing?
Well, I'm doing great. It's interesting to see the month of January. We have had some volatility, but as we close the door on this month, the turbulence in the wake of the coronavirus news, is that really going to persist for the rest of the quarter or potentially the rest of the year in 2020?
You know, volatility definitely has gotten extended a little bit, and probably for good reason here. But, you know, hopefully once this gets contained, and hopefully it will shortly here, the fundamentals of the marketplace, earnings will start to take back over.
Well, you bring up a great point. Earnings season, by and large, we've seen a lot of the S&P 500 already report, and they are beating their expectations. So that's nice to see the strength in the earnings season component despite the volatility.
No doubt about it. And this extended volatility, though, Jeff, does give investors an opportunity maybe to collect a little extra premium.
All right, great stuff. And let's get this first lightning round. You ready, pal?
All right.
Crude oil. Well, talk about volatility. It has been sensational in the crude oil patch. We actually saw the month of January of 2020 start off with crude oil nearly at $65. And here we are with WTI plummeting. Of course, it has a lot to do with the coronavirus, but it's also been interesting to see the supply conversation. Domestically, we're seeing U.S. production reach record highs of 13 million barrels a day, but they're still talking about curbing production in OPEC as well as non-OPEC members. So how do you approach, what type of trade example you utilize as we're seeing a range-bound market, but also dipping to the downside, testing $50 again?
Definitely on that downside, but volatility, like you said, Jeff, has exploded here. So what I'm looking to do here is sell the March monthly 51.48 put spread. The selling of this put spread allows an investor to collect $740, which, because of the increased volatility, is a higher premium level than we've typically seen. This put spread expires week 2 in February on Valentine's Day, February 14th, and the March future is the underlying future contract, trading 52.41.
Yeah, that's really interesting. What we talk a lot on Striking Options, Scott, is about that volatility, that at-the-money volatility. Quite elevated in crude oil due to the fact that we have seen such a movement in the month of January. So that at-the-money volatility is at 41. That's why that premium you're able to collect on this trade example is so high, so elevated. But where does it line up? That $50, that's really been a technical support. So this trade example you're utilizing is really defining your risk, but also kind of relying a little bit on the technical side.
No doubt. It is absolutely relying on that range that we've seen and takes advantage both of that range and an investor being able to collect more premium.
Well, I like that, Scott. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
All right.
Earnings strength. Well, we talked about at the top of the show. We have seen significant strength. Some of the names, we're seeing a lot of different sectors. It's been a pretty mixed bag of nuts when you talk about the actual sectors, but earnings overall have been impressive.
No doubt they have been. And we talked about the coronavirus, and that's really been the fear that's added to the marketplace and maybe held the market back a little bit from capitalizing on these good earnings.
And it's been interesting. The market certainly in Q4, we kind of had a little bit of a melt up, and we had week after week of gains. But yes, this coronavirus has brought volatility and kind of back and filled the E-mini S&P 500. But the way I want to approach this, Scott, is in the event that we get over and the severity of the coronavirus is diminished and we move along, focus back on earnings, focus back on the Fed, and see if we can retest those all-time highs. I want to be a buyer of a call spread. This is going to be a $291 purchase of a call spread of the 3350 $3,400 call spread. If we remember, just a couple weeks ago, we were selling this call spread, but now we have the opportunity to buy this call spread, Scott.
Absolutely, and that's the Feb week 2 call spread. It expires again on Valentine's Day, February 14th, and that's with the March futures trading 32.59 at the money volatility about 17.
And I think it's really important to understand that what we're talking about, selling put spreads, buying call spreads, we're defining our risk. We are going to be very receptive to the fact that volatility has increased, and we're approaching the markets because we think January will set the tone for the rest of 2020. But it's interesting to see that the market seemingly has much more constructive undercurrents, despite the fact that we have been given a little bit of a curveball with the coronavirus.
It really does. And the most important thing that I think you just mentioned there, Jeff, is defining risk.
All right, well, great stuff. Thanks, as always, for coming on to Striking Options, Scott. We want to thank you for tuning in. Make sure you tune in every week as we will continue to strike options.